Hi and welcome to Reliance Expert Series. We have with us Mr. Amit Tripathi, CIO Fixed Income. It's a great opportunity to understand the fixed income market from an investor's perspective. Welcome, Amit. How do you see the debt markets here on now that major events such as the budget has taken place and the RBI policy meets behind us?
I think last time around we did discuss about the budget because the budget was already passed when we were giving the monthly briefing for January. So clearly the budget has been a very good event as far as the fixed income markets are concerned. Not only did the government broadly adhere to the fiscal discipline roadmap, qualitatively the budget was much better. At the end of the day, the amount of borrowing that the government decided to do from the markets was less than what the market expected, and these would possibly be almost static in terms of the gross amount of borrowing that the government is going to do, 2015. So for the last 3 years, the absolute amount of borrowing that the central government is doing from the markets has remained the same in spite of the kind of growth that we have seen in nominal GDP. So clearly the budget was a very, very positive phenomena from an overall market perspective. The budget was followed by the RBI credit policy, and clearly the RBI credit policy, the pronouncements in the RBI credit policy was something that was a surprise to the markets. The bigger surprise came on 2 points. One, the market was indeed hoping for a 25 basis point rate cut in the policy. That didn't happen. But more importantly, I think what actually caught the markets by surprise was the fact that RBI changed its overall monetary stance from being accommodative, which essentially means that they're looking for spaces to cut rates, to neutral, which essentially means that they think that the level of interest in the economy are appropriate and they don't need to cut rates at this point in time. This was clearly not in line with market expectations as on the policy date. The reason RBI chose to change its stance, which is very important for all of us and investors to understand, is that the RBI believes that while inflation has come down in the economy in the last 2 to 3 years, there is a particular point in time, which is essentially March 2018, where the RBI had targeted to reach consumer price inflation number of 4%. Directionally, we are moving in that path, but the RBI does see risks in terms of achieving that, and also does see risks in terms of the second half inflation for FY18 being higher than where they would like to be. So given the fact that RBI has been so focused on inflation over the years, and they have maintained a monetary policy stance to ensure that inflation goes through that glide path, that part was true. The fact that might have bothered RBI, the fact that towards the second half of this year, for a variety of reasons, we may not achieve the 4% mark as far as headline consumer price inflation is concerned. And hence the RBI thought that it might be prudent from a very, very conservative stance perspective to be on hold. Although if you were to look at the recency in terms of data, where consumer price inflation has actually come much below 4%, around the 3.5% mark, where core inflation has not come down as aggressively but has stayed well below 5%. The recent data might have given space to the RBI to cut rates, but since RBI is looking 6 to 12 months down the line, and they believe at this point in time inflation may not reach the 4% mark by March 2018, hence they have stayed on hold. This is but one of the reasons which we believe the RBI stayed on hold. The other two reasons are that we have seen the probability of the Federal Reserve doing more rate hikes during this year increasing. In fact, there is a lot of thought that the next rate hike from the Federal Reserve might come as soon as March of this year or June of this year. And if that were to happen, that also has its own impact on global markets per se. Not only it impacts the US economy, but it also impacts global markets, whether it is the equity markets, the fixed income markets, the currency markets. So that might create some amount of volatility. The third factor is that commodity prices, whether it is oil or whether it is ferrous, non-ferrous commodities, we have seen some inching up in these prices. If you were to take a time frame of last 6 to 12 months, that will pass through in terms of inflation. So in India, while consumer price inflation has actually come down quite admirably, what has also happened in the last 6 months is wholesale price inflation, which is the raw material and input prices for producers, that has moved up because commodity prices have moved up. So I would say these three reasons. One, RBI is actually looking 6 to 12 months down the line in terms of what they believe inflation will be vis-a-vis what has been the case in the very recent past. The fact that US Fed is on the hiking path and there is reasonable probability of more rate hikes in the next 3 to 6 months, and its attending impact on currency markets, fixed income markets and equity markets globally, and the fact that commodity prices have inched up. There will be some pass through ultimately in terms of higher commodity prices into higher finished good prices. There might be some tertiary impact into the consumer side of things also. So RBI might have wanted to play it more conservatively. So ultimately, in the overall scheme of things, did the market get it wrong? Broadly speaking, yes, this time around the market did get it wrong. From a macro prudence perspective, is it a good policy? It is a very, very good policy, and I would say that it is conservative and good from a macro prudence perspective. And hence, while on an immediate basis the recent rally in bond prices has stopped because of the change in stance from accommodative to neutral, in the longer term perspective it does wonders to the bond prices if you have a central bank which is looking much ahead and is much conservative from an inflation perspective, because it allows longer tenor yields to stay lower for a longer period of time. So there is a short term and there is a medium to long term part of what the RBI has just done.
Okay. So, sir, as you mentioned in your earlier part, your second point, where you said that the US Fed is going to be increasing, it's facing increasing rates. How do you think this is going to affect the Indian debt market scenario?
There are 2 or 3 answers to this question. The first is, does the US Fed rate decision impact emerging markets such as India, and through what channels does it impact? It does impact because globally all markets are very interconnected nowadays, and hence what the US Fed does in terms of its rate decisions not only has a direct impact on US yields and overseas yields, but also has many indirect implications in terms of all financial markets, whether it is commodity markets, equity, fixed income, and especially currency markets. In India, because the foreign participation in Indian bonds is very low, less than 5%, the major impact of interest rate changes globally comes through the currency markets. So it does impact India in that sense. If you actually look at it more in terms of correlation, in terms of Indian bond yields and US bond yields, that correlation is not very high in the long run, because India macro is what determines Indian interest rates. Just to make that point, between 2011 and 2014, when globally rates were coming down, US, EU, Japan, everywhere rates were coming down, Indian rates were actually going up because the Indian macro was not in a very good shape. And in fact, the spread, if you look at the spread between a US 10-year yield and an Indian 10-year yield, had actually increased significantly during that period because we were facing macro headwinds at home. Since 2013-14, when Indian macro has started improving, Indian rates have come down much more than what global rates have come. So in the immediate short run, US Fed rate decisions will have an impact not only in India but globally. That has already been factored into a large extent today when we look at bond prices, but it does have an impact. In the long run, Indian rates are more about India macro. Believe me, I think we have seen the best macro environment in India in the last decade or so, which is the current environment. Inflation is at an all-time low. Core inflation has come down admirably. Fiscal deficit is at an all-time low as far as government fiscal deficit is concerned. Current account balances are very healthy. India is today looked as a very, very favorable destination, not only by Indians themselves, but by a lot of foreign players. So if you ask me, what will be the impact of this Fed decision 12 to 36 months down the line? I can tell you that it will hardly be felt if you are an investor who is staying in Indian bond markets invested for 2 to 3 years and beyond. Because ultimately over 2 to 3 years and beyond, what will matter is what India does with its macro and what happens in terms of Indian markets liquidity, in terms of Indian credit scenario, etc., rather than just what the Fed does in March or June in terms of rate hikes.
Recently, there have been fears regarding accrual funds due to the credit ratings being downgraded. What do you think, Reliance as a fund house, how is Reliance going to be, handling these credit risks?
So I think credit risk is an integral part of the overall fund management piece. It is true that, depending on which type of scheme mandates one runs across mutual funds, including Reliance Mutual Fund, there are some schemes which will have higher exposure to government securities, AAA rated bonds. There will be some other schemes which will concentrate more in the accrual space, where we will invest in a combination of private sector credits where ratings could be in a range of AAA, AA, and even single A to a certain extent. And hence, the amount of credit risk would be different in various schemes depending on the mandate of that scheme.
Right.
So that is true at all points in time. We have run these mandates for more than a decade now, and we on a real time basis have been looking at the credit risk in these mandates from time to time. Only 2 or 3 thoughts here. One, credit risk management is a serious business. You need to employ time, energy, the right people into managing credit risk. It's a very holistic kind of an exercise which you have to do in and day out. You can't rely on external opinions. You can't rely only on credit rating agencies. You have to do almost 90 to 95% of the decision making exercise internally using your own proprietary credit research, primary data, primary information, secondary information, etc., which is a very, very exhaustive exercise. Today, Reliance Mutual Funds debt team, out of the total number of people employed in the debt team, more than 50% are employed only as dedicated credit research analysts. That gives you an idea of how much focused we are in terms of looking at credit research minutely, in terms of overall managing credit research. At the end of the day, we believe that mutual funds are all about fiduciary responsibility. We are managing investors' money, and hence for us, safety first is always the best way of approaching investments, including debt investments. And hence we take credit risk only to the extent we understand it, we can mitigate it, and we have priced it properly. If that is not the case in a certain circumstance, we would rather avoid taking that risk just for a few basis points more in terms of accrual. So it will always be safety first. And wherever we are taking credit exposures in terms of rating parlance, be it AA or single A or whatever, ultimately that credit risk will be taken in our books after thorough analysis, after thorough documentation, and after making sure that we have protected ourselves sufficiently against those type of risks that might come from time to time. Can one make error? Obviously, it's not a zero probability event that you will never have credit risk coming out, but the idea is to minimize it, to mitigate it, and to ensure that even if the thought process from a credit perspective goes wrong, you have enough mitigants in terms of covenants, in terms of early exit options, etc., to move out when the time comes to do so.
So, sir, now FD rates are being going down. As an investor, where do you think I should be investing?
See, the beauty about debt mutual funds is that we have unique proposition for different types of requirements that investors have. The good thing is that mutual funds offer solutions and unique solutions for each of these propositions, whether you want to invest for a shorter period of time, whether you want to invest for medium to longer period of time, whether it's a part of your long-term debt allocation that you're looking at mutual funds as. There are unique solutions for that. At the end of the day, the argument is that one should prefer mutual funds only if we are able to provide more efficiency in terms of returns, adjusted for whatever exposures, risks, etc., that the investor is taking by investing in mutual fund products. And the answer to that is that at least in the last 10 to 15 years, I have seen these markets, mutual funds and Reliance products very closely. That has been the case more often than not, that these various mutual fund products have been able to deliver more efficient risk-adjusted returns, much more attractive than what is available in traditional savings instruments. So even now, when the overall interest rate environment is lower, we are more than confident using the various schemes of Reliance Mutual Fund, investors can get returns that are far more efficient and better in their respective time horizons. So we would continue to encourage investors to come in and invest across various debt funds. They should be careful about two things very clearly. One, their own risk appetite. They should choose the fund depending on the risk appetite. And two, most importantly, marry the product in which you are investing to your tenor requirements. Don't get into products which are efficient over a 3-year period if you have a 3-month horizon, and vice versa. So whatever is the investor requirement, they should either read through or ask their advisors to give them specific products which suit specific tenor of investments. So as long as you have worked out on your risk appetite and you have worked out on your tenor of investments, you will choose the right product. And if you choose the right mutual fund product, it is almost a given that you will end up getting returns that are far more efficient.
Thank you so much, Amit. It was a pleasure having you with us. It was indeed a very insightful discussion to have with you, which would rather help me invest better. Thank you.
Thank you.
So if you have any questions, you could write to us on this email ID, or you could also follow us on Twitter. The details of the same are mentioned below. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.